Well, look at that. Looks like we are live. Only done a couple of these so far. I'm in my office here in St. George, Utah, and want to answer any questions you might have about real estate, home loans, real estate investing, anything that has to do with real estate financing is what I specialize in. So I've been doing home loans since 1999. I moved to Southern Utah in about 2005 or so and really love this part of the state. I do a lot of lending throughout the I-15 corridor up from Salt Lake City down to Las Vegas. I do the Reno area, Lake Tahoe area. I've had some properties up there. I absolutely love that area. But my main office is here in St. George, Southern Utah. And I just love this part of the state and love to answer any questions you might have about real estate, buying a house, refinancing a home, reverse mortgages, cash out refis. I mean, all that stuff out there. I often tell people I sell money for a living. That's really what I do is I sell money to buy real estate. And some of it can be traditional. We're talking the Fannie, Freddie, FHA type of loans. And other times it might be non-conforming or what's now called non-QM loans, where it's maybe bank statements for income verification. A really popular program is called DSCR, which is basically a debt servicing loan, where if the rents cover the payment on an investment property, then you can get your loan. There's no tax returns or any of those things required on those types of loans. Now, obviously, the rates are going to be worse because you're providing a little less documentation. There's a little more risk involved with the income verification. So the rates are worse, but it can be a great program depending on the needs of the client, especially if you're just starting out or you don't have a bunch of tax returns or write too much off. You either pay more to Uncle Sam or you're going to pay more in interest is usually what ends up happening with those types of loans. But if you have any questions, please post them in the comments. I'll try to keep an eye on the chat there. Otherwise, I've got some questions that came in off of some Facebook posts I've done, also came in off some other things. So let me pull up that list. Let's see. Here's a question I saw is, what impact does rising mortgage rates have on the mortgage industry? One of the biggest things we're seeing is there was years of refi business, years of people that were at a higher rate that could dramatically go down to these historically crazy giveaway interest rates. They were in high twos, low threes for almost everybody that had a rate that was higher. I think I saw one report that showed that we did like 6 years worth of refis in like 18 months. Like the same number of traffic, the same number of loans were closed within a very short period of time. So there was mortgage companies just making money hand over fist during that time. And since that, rates have moved the other direction. Almost nobody needs to refi. Like refi business is down to, if it's not down to a historic low, it's got to be close because most people took advantage of those lower rates that they don't need to refinance unless they're pulling cash out or paying off a first and second, maybe getting rid of mortgage insurance. I mean, there's always going to be some refi out there, but how quickly rates moved up, refis dropped off dramatically. The other problem we're seeing is because rates were so low, existing homes aren't going on the market. So inventory is also really low on people trying to purchase a home. So you got these clients that don't want to sell because they've got such a low rate, even if they want to upgrade, even if they want to go buy something else, maybe they've got a ton of equity. They just can't replace the house they have because not only are they going up on the cost, but now the rate's also going up. So for mortgage companies, we're seeing them really tighten up as far as any kind of extra fees. You see marketing is slowing down a little bit. Operations people that process, underwrite, you're seeing those jobs getting laid off or really coming down or getting furloughed or cutting hours, that type of stuff. Because that's one of the real hard costs for a mortgage company is operations. Like guys like me, the loan officers, the originators are usually straight commission. So they're not being affected as far as the mortgage company itself quite as much as operations staff. So you are seeing, that's where you're seeing mortgage companies having to make cuts and really circle the wagon, so to speak, knowing that, okay, purchase business is really where it's going to be at for the next few years, maybe even longer. And there's even less homes. So there's more of us fighting for the same amount of business. So you're definitely seeing things tighten up for mortgage companies. I see so many of them doing everything they can to keep their staff because they know when it does turn, the floodgates could just open up and all of a sudden turn times could go to months to get a loan closed instead of maybe weeks. But they can't just keep kind of paying for all this staff if the loan volume's not there. But I've seen many companies are making big sacrifices just to try to keep people on board and just wait out this slower time for a mortgage company. So that's probably the biggest impact that interest rates have on mortgage companies. Now let's see if we have any questions in the chat. Okay, we'll keep going to the next one here. I think this is only the second time I've done live. I thought it was fun, so thought I would just pop in here on a Friday and jump in and see if I can answer any questions for you. Here's kind of a general question. What is the catch to a reverse mortgage? So the reason it's called a reverse mortgage is you take out a loan balance, and instead of making a payment to lower the balance actually goes up. So it's reverse. So as you don't make a mortgage payment, the interest gets added to the loan. So that's really the biggest catch that most people don't realize with reverse mortgages is that the balance doesn't stay the same. Your equity is making your payment instead of you making the payment. So they're a lot safer than people think on the back end. The mortgage company doesn't own the home. It's still a lien against the property, just like any other type of mortgage. There's different clauses that kick in to call the note due, but it is a lot safer of a loan since FHA kind of took it over and since there's been more regulation on reverse mortgages. But the idea simply is that instead of making a payment, your equity makes your payment for you. Now, a lot of times these reverse mortgages are only loaning 50 or 60% of what the home is worth. So there should be plenty of room before that house were to go upside down, say more owed than what it's worth. But there's even mortgage insurance that kicks in, even if that is the rare case where it becomes upside down. And let's say mom and dad want to sell the property, or let's say dad passes away, mom doesn't need that big of a house or wants to move into assisted living. You can still sell the house, pay off that loan balance, and keep whatever's left over. So it is a good loan. You want to educate yourself on it. I think sometimes it can be oversold a little bit to maybe the people that just qualify for the loan instead of people as they get a little bit older. But I think it's a much safer loan, and it's really a good loan. Just like any loan, it's going to have benefits and disadvantages, but there is a lot of advantages to a reverse mortgage. Let's see. Okay, let's see what else we got here. How long do we want to stay on here? I see a little timer up there, so maybe we'll give it 20, 30 minutes or so, see if anybody jumps on. Let's see. Are interest rates too high? It's all relative to what you mean by too high. Are they higher than what they were? Sure. Are they lower than what they've ever been? Absolutely. So it does come down to what do you mean by too high? I think the scary thing is how quickly they went up. I mean, we didn't get, it's almost like they should have gone up faster in a sense with the Fed, should have maybe jumped things a little bit quicker. But at the same time, it was just amazing how much that you see lenders and everybody hedging the bets a little bit, so to speak, by being higher than that 30-year treasury. So if you look at the 30-year treasury bond, most of the time mortgage rates are about 1.5% above that. Last I checked, I think it's like 3.25% above that right now. So they're actually a little higher than what they would need to be because they kind of keep anticipating if inflation becomes a big concern, if the Fed keeps raising the interest rate, that they want to be ahead of that a little bit instead of behind. So like for instance, if you knew the Fed was raising rates 6 months from now, or they keep talking about raising rates every quarter, you're not going to wait for them to raise the rate. You're going to raise it now. So that's what we're seeing is kind of this, ahead of it. So as inflation starts to get more in line with what they want to try to get it to, the Fed will stop backing off the talk about those rates. And I think you're going to see that yield kind of tighten up back down, maybe closer to 2%. So I think there's more pressure to move rates down than up. We're also going into election years. We're going into some turmoil about uncertainty there. And uncertainty always breeds a little bit of risk and always breeds a little bit of hedging your bet, so to speak, or just kind of like, okay, let's wait and see. Let's just wait and see what's going to happen with news cycles, with who's going to get elected. Those types of things always put a little bit of a wait and see mentality in the marketplace. So I think you're going to see more pressure for rates to move, or just at least just flatline, kind of stay where they're at. And we'll see kind of what happens at the last quarter of the year. And then as we head into 2024. I think there'll be more pressure to move rates down, honestly. Inflation has gone down or has gotten curbed, and I think you're going to see rates probably trickle down a little bit. Now, major, no. I don't see anything to get us back into 3%. What caused 3% in the first place was a perfect storm of all kinds of different things that I don't think or want to see happen again in a lot of ways. Yeah, we got benefits of lower rates, but we also had all kinds of other stuff, pandemics, people dying, people losing their job. I mean, so there's always a balance between wanting a better rate, but then having everything else go to heck in a handbasket. So it is something where I think we'll see rates come back down a little bit, but I don't think we'll ever see anything that we saw for almost 10 years, having rates in that 3 to 4 range. Upper 5s, maybe 6s most likely. I think somewhere in the 6 is where we're going to see it level off for the foreseeable future. Let's see. Let me go through a couple other. Let me see if I can find a couple other. If you have any questions, comments, please post them in the chat here. I'll keep an eye on that. Hopefully, it'll give me a little alert when it pops up. First time I've done these live, so I'm still kind of getting used to them. Here's the question, kind of the same thing. How do current mortgage rates compare to those of previous years? So in recent memory, rates were a lot lower. We're definitely higher than what they were. But ask any of your either parents, grandparents, kind of depending on what age you are, of any kind of Carter years or any kind of things where rates were 12 and 13%. Now, I will say the home prices were obviously a lot less too. You're not dealing with a 13% interest rate on a $500,000 median home price. But at the same time, there's plenty of reasons to see that we were heading that way with inflation. They were able to kind of cap it there at 8%, but we've seen inflation even higher than that in American history. So, and then we saw it kind of tail back down. Now, I think last report's around 3, somewhere in there. So that definitely helped to get that curve back down before it became even worse. So that's why, again, I think we'll see some pressure to maybe move rates down a little bit, but I don't see a crazy move to move rates way down. But if you look at, there's plenty of charts online that you can find that we've had rates as, 30-year fixed in the 13% range was what has happened. But if you look at the last 50 years, the average was right about 7%. So it is something where right now we're basically at a 50-year average, but I still think we'll see some pressure to move that rate even below that a little bit. All right, let's see if we've got any other questions. Let's jump into the real estate section I have here, see if there's any real estate specific questions. Let's see. Oh, let's go. I think I hit the wrong tab here. Let's see, here's a bunch of questions about real estate that I can do. Will the Fed stop raising rates at their next meeting? Maybe. I mean, their target is to get to 2%. They're at 3, but I think it's enough of a curve heading in that direction. I mean, from everything I'm seeing, it probably will stay the same, is what it would be my guess, my prediction. Let's see if there's some more in here. Let's see, what should individuals consider when shopping for a mortgage in light of the current interest rates? So it is something where I always ask people how long they plan on keeping the home. If you're keeping it for a shorter period of time, let's say it's a short-term, first-time home buyer type situation, you might be graduating school or having kids or getting married or something in your life will change to where you need a different home, upgrade, downgrade, whatever it might be. Knowing how long you're going to keep the home really should help determine what type of loan you're going to get. If it's a forever home, if you have no intention of moving for years and years and years, let's say the kids are 10 years old or 8 years old and you want to wait till after high school, you're in the right school district, whatever it might be, where you really see that home being indefinite, like longer than 5 years, you have no idea. That's where you may want to look at some buy down options, or you might want to look at paying some fees or that type of stuff to get the rate a little bit lower. But a lot of times the break even point on that seems to always be about 3 to 4 years to the cost to get it versus what you're saving every month. If you buy down that rate and you save $20 a month, but it cost you $2,000, you got to save that loan a long time before you even break even. So I always like to run the numbers for my client and say, okay, here's the rate at this fee, here's the rate at this fee, here's the break evens, which one makes more sense? And I'm amazed at how often people will choose a little higher rate to save on the fee because of that time frame they're going to be in the home. So I think that's really what you want to consider. But here's something else. If you buy a home today and versus waiting for a year from now, you will gain that appreciation for the next year. And if rates happen to lower, you can always refinance. So you're getting best of both worlds. If rates go up, then not only are you getting the appreciation, but you've also locked in a housing payment that is better than what you can get. And I often have people say, hey, I want to wait till interest rates go down, but they're paying 110% interest on their rental property. And they lose out on any appreciation during that time, along with tax benefits, those types of things. So there's an old saying in real estate that I think is very, very true. It's crazy how often you can look at this snapshot. The best time to buy a home was 6 months ago. The second best time is right now. I still think there's more reasons to own a home. You're going to have a housing expense anyway. Why not own it? And if rates happen to go down, then you can take advantage of a refinance and take advantage of that equity going up. So let's say you use a loan that takes less money down, so it has mortgage insurance on the loan. There's a likelihood you're going to be refinancing to remove that once you have enough equity anyway. And if rates are lower, then you get kind of a double win-win. So I still am a big believer in real estate. But for years, they were just giving money away. So it made crazy good sense. Now it makes sense, really good sense, because of having a housing expense. Maybe not quite as good as it was a few years ago, but it's still way more benefits to own a home than to rent. Now, there's always a time and place to rent. Don't get me wrong. moving into a new area, I don't think you should move into a new area and buy a home right away. Sometimes it's good to get settled in an area, make sure your job's stable, make sure that the school district you want to be on if you have kids, or close to the job you're going to be. It's always good to kind of get acclimated to an area first. But I see way too many people are waiting for some perfect scenario, which won't happen. Because if rates do go down, guess what happens? A bunch of properties show up on the market, or you got a bunch of other buyers that are waiting, and all of a sudden they gobble up everything that's up there. And usually rates will move quicker than supply can catch up to. So there's just so many more benefits to owning a home, regardless of the market, than not. And with rental payments, they always change. There's a lot of pressure to move rates up on renting than there is really on the housing payment. And once you get a mortgage, it's a fixed, locked-in payment. The only thing that really changes on mortgage may be your taxes and insurance, and that's such a small change versus the landlord selling to somebody else, and now they have to raise the payment $500 or $1,000 or something like that. So there's a lot more pressure on moving rates up than moving rental rates up than the mortgage itself. So I think you're always going to be better off owning a home. You really are. And yeah, let's see what else we got here. Okay. How are we doing on time? 16 minutes? All right. I wonder if I keep bumping. Oh, I keep bumping my desk and moving the camera. All right. I better take my hands off the thing. All right. Why did my interest rate go up on my car loan? So some loans, not just mortgages, are tied to the Fed funds rate if there's some sort of adjustable rate. So this is going to be a lot of Visa cards, some student loans. Some car loans are tied to prime, which is where when the Fed raises the rate, that's the index that's changing. And then home equity lines of credit, a lot of them are tied to that. So we've seen a lot of people see that payment go up. And then, visas, a lot of visas can be tied to that. So I don't know a lot of car payments that are, but there probably are some out there. And a lot of times they just offered a better rate to begin with, and that's why it's some sort of a adjustable rate car loan. So that's probably why it went up. Unless there's some sort of forced place insurance, that could be something else. But it does say here, why did my interest rate go up on the car? So maybe that probably has something to do with the type of loan that secured the car. All right, let's see. Let's go to real estate. I want to see if I can find something real estate. Let's see. What are the requirements for an FHA loan? I'm a co-borrower on a conventional loan. If I get my name removed from the conventional loan, can I obtain an FHA loan afterwards? Short answer, yes. I mean, you can have more than one FHA loan out. So it's not something where you have to have only be a first-time home buyer or have another property there. If you are on another loan, there could be a debt ratio issue. So that way you may have to qualify for essentially both properties. So it can become a little bit tricky there. But there is some loans where you can only have one, like VA loans. There's certain loans that you can only have one out at a time. There's some exceptions to that, but generally speaking, you can only have one out at a time. And FHA is not necessarily one of those, but it is something where you're going to have debt ratio issues when it comes to having two mortgages out there. You basically have to qualify for both. And if you can't, then you'll have to refinance or take your name off of it. So it depends on kind of why you're a co-borrower there as well. But all right, let's see. How do banks approve mortgages? Do they always require proof of income and assets? No, they don't always require proof of income or assets, but the better rates, the better mortgage programs will require those extra documentation, the extra proof of it, because it lowers the risk. It's something where the more they can check the boxes and the guidelines, they're lowering the risk of foreclosure. So it is something where they do want as much income and asset verification as they can. But there's loan programs out there that don't require income or assets. They're just going to be higher rates. That's really how it works. And it depends on credit scores. It's going to depend on a lot of other factors with it, but that's really a big part of the box. There's really four major things that lenders are going to look at, and income is one of those big ones. Credit's a big one, the property type, occupancy. These are kind of things that lenders look at. Now, some won't do it. Of course, not every lender does loans that are stated income or bank statement loans or DSCR, all these other acronyms that are out there. Some gravitate towards that type of business. Some gravitate towards other type of business. Some even are even more strict if they do just the cookie cutter traditional loan. Some are even more strict. So part of my job is to find out, okay, my client walks in with a certain scenario. I'll know which lenders are most likely to offer that client a loan and which are offering the best interest rates. But I'll tell you, the interest rates you see advertised, just like car loans, it's only like 5% of the population that gets that interest rate because it requires big down payment, big credit score, low debt ratio, been in the job, all the boxes have to be checked for that because they're advertising the best rate that's out there, where most people are going to be a little bit higher than that interest rate because of just whatever they don't quite fit in that box. Maybe they haven't been on their job for 5 years. Maybe it's only been 1 year. Maybe it's only been half a year. Maybe they're self-employed now. Maybe they're W-2 now. Maybe they're commissioned. There's all kinds of different things out there. It's just crazy, all the guidelines we have for just about every scenario. It's just crazy how after you have years and years and years of doing mortgage loans and see which loans perform, which ones don't, what guidelines worked, how people change on how they earn their incomes, laws change, things just change. And it's amazing how underwriters stay on top of that data and create a guideline for it. Like some of the guidelines, you always wonder, what's the backstory with this guideline? There has to be something happens somewhere that triggered, okay, hey, everybody, here's a new income source we've never seen before. Here's how we treat. Like cryptocurrency was a great example of how they started kind of treating, how do we count that as either income or asset, because it is something that's kind of new and fresh. So they had to come up with a guideline for it. And it's amazing how quick they adjust to what's out there in the marketplace. How are we doing on time? We're about 20 minutes. Maybe we'll go a little bit longer. If you have any questions, let me check, make sure we got my chat on here. I love what I do for a living. I've been doing real estate since 1999. I've been in Southern Utah since 2005 and just really love this part of the state. It's just a great climate, golf, wonderful. It's new. I just love Southern Utah. If you've never checked out Southern Utah or Zion National Park, or you got to look it up. It's just an incredible area. I just love this place. All right, let me go to my screen here. Let's see. Does foreclosed collateral surrender third-party rights to purchase, going concerns like compound interest does? I don't know what that means. That's typed very incorrectly. Oh, yeah. Why do first-time home buyers increasingly opt for FHA loan with low down payments? So first-time home buyers usually have some guidelines that don't quite fit what's called conventional Fannie Freddie type guidelines. That's really what it is. Usually the credit scores can be a little bit lower. Usually the down payment is less. Usually the time on the job might be a little less. Maybe they've been in school for years. They just graduated. They just started their job. So their job history might be a little bit less. So FHA really can help bridge the gap between saying no and what conventional loans do. So conventional loan standards are just a little bit higher than FHA in most cases. Now, there's certain things FHA is really strict on as well that maybe conventional isn't as much. So they both have a need in the marketplace that they're both trying to fill. But a lot of times it's a little less money down. It's a little less credit score driven. So it's something where you'll get more yeses with FHA potentially. And I would say job history, that type of thing, or they've got a bunch of different jobs, part-time jobs, working for, Pizza Hut delivery or, other things while they're going through school, stuff like that. So generally speaking, the guidelines with FHA can be a little bit looser for first-time home buyers. And I would say the biggest thing is credit scores. But once you have a certain credit score, that's where mortgage insurance can be cheaper with conventional loans than FHA. So then your overall payment can be lower. Again, that's part of my job, is to sit down with a client and say, okay, here's how an FHA loan would work for you. Here's how a conventional loan would work. And I've seen a lot of times conventional rates can be higher, but the mortgage insurance can be cheaper. So then the overall payment can be cheaper. Plus with FHA loans, that mortgage insurance doesn't go away anymore. It doesn't go away for the life of the loan unless you put a lot more money down, where conventional loans have an option to get rid of it without having to refinance. So there's that option too that can drive people kind of one way or the other. But every loan, whether it's a 30-year fixed, an adjustable rate, an FHA, a 203K loan, all these out here all have little benefits and disadvantages, and they're all trying to fit a need within the marketplace to help people buy a home. That's what's great about our country. There's a lot of incentives. It's part of the American dream. It's so many benefits to owning your own home. For the community, there's benefits for owning your own home. There's so many things about home ownership in America that just makes it part of the American dream. And there's a lot of programs to help you get into a home. So that's kind of why people opt out or opt for an FHA loan versus conventional. But if you're not looking at both, I think you're doing a disservice to your client to at least explain kind of how these work and why that's a better loan option. Let's see. Why do mortgage underwriters wait until the last minute to request documentations to close on a home? It always seems like that, right? And it's funny because most of the time, if you're getting your job done correctly, you're upfront with clients, you're upfront with the real estate agent about what are the pitfalls, what are some of the things we may have an issue with underwriting. That's just part of being an experience. It's just part of going through this process so many times. When you see something, you can go, ooh, that might be an issue. We may need to address that. But a lot of times something new or new documentation might come in that changes the underwriting approval. So it sucks how often it does seem to happen towards the end. But it is something where if you're on top of it, you're getting the documentation, you're not waiting till the last second, you can avoid some of those things by just being on top of it. But frankly, their job is to say no in a lot of ways. I hate to say it like that, but the underwriter's job is to follow these guidelines, find a reason to say no. And if it falls through that scrutiny, if it kind of makes it past that scrutiny, it's a quality, clean loan. So their job is to find a reason to say no, way more than just trying to say yes to every loan program. So, but they want the deals too. It's not like they're trying to kill the deals, but they want clean deals. They want safe deals. They want to protect the industry, the company, their job, all those types of things, because if something goes wrong, it can come back on the underwriter. If they miss something or if they just turned a blind eye to something, that can be a big problem when you're talking hundreds of thousands of dollars on these mortgage loans. So it is something where the underwriter's job is to be a little on the safer side, but if you're on top of it, getting the documentation, turning in the paperwork, explaining things as much as you can. Just explanations make a huge difference. Letter of explanation, sign those letters, explain why that deposit showed up or why the credit is the way it is or why the job changes. I mean, that's part of my job is to make that process as smooth as possible. But stuff pops up, stuff happens, and it's something where that's part of our job. And I've had clients that go out and get a car loan or something. We always try to tell them, don't get a car loan. Don't get a furniture loan, even though you're pre-approved and you got your clear to close and all this type of stuff. People, oh, great. Now I can go get my furniture package at the furniture store. And they go and get a $20,000 line of credit for 90 days, same as cash or whatever it is, blows up the deal, or at least causes the underwriter to have to go back through it and add that debt. So stuff does happen. Communication's huge. Setting expectations is huge. Working with people that are experienced can really smooth out these bumps. Not every time, stuff happens. But the more you're communicating, the more you're upfront with people, the better off you are. And honestly, it's a lot easier to remember what's going on than come up with some lie or deceive people on, hey, yeah, we're good with the underwriter when you really haven't even submitted the loan yet. I can't tell you how many loan officers are just in the background going, okay, I think we're good to go, and giving the warm and fuzzy to the agents and the clients, hoping that something won't come up, and then something comes up. Those are always the one where something comes up where you say, yeah, we're good to go for Monday. Then Monday comes around, the underwriter says, hey, I still don't have your updated pay stub or still don't have this or that, and then you're like, oh no, and it just causes so much stress on processors and funders and everybody in this process. So I think that's one of the best tips I can give everybody, whether you're a loan officer or a person, just be upfront, set realistic expectations, and just follow through, answer the phone, and get to the bottom of it. All this stuff is man-made. All these guidelines, all these disclosures, all this stuff is man-made. So there is a man-made solution in almost every situation. So hope that helps. All right, well, let's go through one more here. Make sure I didn't miss a chat or anything. And let's see, got an email there. I can check that later. Let's do one more. Excuse me. Ooh, why is it important for buyers to understand their credit profile before purchasing a home? Wow, that's one of the biggest factors. Like we talked about, income is a really big factor on proving you can make that payment. But if you have a bad credit score, you can have all the income in the world. You're not going to get the best loan. And vice versa. You can have the best credit score mathematically possible. Without the income, you're not getting the best loan. So they really go hand in hand. But knowing your credit profile can make sure that you're not missing the better tier. So a lot of loan programs are based on these 20-point credit tiers. So if you're a 719 on your credit score, and you can do a few little things to get you to 721, you could jump into another credit bracket. So knowing where your credit scores are at, what's on there, make sure it's up to date, make sure it's accurate, or make sure you're maximizing your credit score can be a huge saver to you and get you a better loan approval. So I've had a lot of clients that, their lease is up October 1 and they start calling you a month away. That it's crazy how many times like, man, if we just would have had 30 more days to maybe work on the credit a little bit, maybe pay down a credit card, maybe it's a collection you didn't know about, maybe there's some Sprint account or internet bill or something where the equipment wasn't turned in. I mean, raise your hand if you got that stupid thing on your credit. Or medical collections. Talk about medical collections. They're a joke sometimes how fast they can just show up on the credit, even when you haven't gotten a bill yet or you thought the insurance was covering it. So medical's a whole nother ballgame. But it is something where start early. If you have a lease or something where you're thinking about buying even 90 days out, you should start working with your loan officer now to make sure that you're ready by the time your lease is up. So you can, if a property pops up on the market that fits, you're ready to go. So really get your credit pulled, get that pre-approval started, make sure that you're ready to go. There's always times you can build up your credit better. Always. I've never seen a credit report that couldn't be approved a little bit. Now, maybe it didn't need to. It's 850 or whatever. It's just a great credit score. But there's crazy more often how much they're just barely short of a tier that we can get up easily with just a little debt management, inquiry management, something, or dispute something that's old. I mean, there's just a lot of things you can do once you know why your score is the way that it is. So don't wait. We're a microwave society. I get it. When you finally realize, oh man, it's this, and you just put it off to the last second, or you don't really think about it because your lease has got a couple more months away, start a little bit earlier and find out where you're at, because maybe you do need to stay in a lease or extend your lease or go month to month, or maybe you're ready to buy a house right now. How great would that be? How great would it be to own your own home? Find out what you qualify for. Now, I have people saying, well, rates are bad and prices are bad and all that. I'm just going to wait it out. You're never going to time it right. You never are. And maybe a few years ago, $2,500 a month afforded a lot more home, and it doesn't afford quite as much now. But it still affords a home. There's still a home out there that we can work on. And if you're ready when it comes on the market, bam, you can jump on it and be ready. Instead of being in line with everybody else, getting all your stuff in a row and just missing out on that house. So it is something where if you want to get into home ownership, start earlier. You can check out my website at ryanbolton.com. I lend in the states of Utah and Nevada. Our company is licensed in a bunch of different states. I think back east is where it gets a little more hit and miss on the states that we offer, but I can get you to the right person. If we can't do it, if I can't do it directly, I can get you to the right person that can help you get approved in Texas or wherever else you happen to want to move or live. But those are the states that I focus on, is Utah and Nevada. So check out my website at ryanbolton.com. Love an opportunity to work with you. If you have any family, friends, anything like that. If you have any questions, submit them on my Facebook page or on the channel here. I'm trying to put new videos up every once in a while here to try to keep it relevant. And I really just like what I do for a living. I've enjoyed doing it for many years. I have investment properties of my own. I do fix and flips. I do all kinds of different things when it comes to lending because I'm a big believer in real estate. And I really enjoy helping people get into home ownership. So check out my website again, ryanbolton.com, and we'll see you on the next video. And where's my mouse? There it is. See you on the next video, and hope you have a wonderful weekend.